So you'd like to create a tax-free retirement income, and maybe you're considering life insurance as one of those tools. Today, we talk about the things that you need to understand about cash value life insurance before you take the first step. Hey, my name's Weade. I'm the CEO and founder here at Howard Bailey Financial. Today, I'm here with you to discuss cash value life insurance and how this works and what you need to know, most importantly, before you take the first step and start considering this as a tax-free income vehicle for your retirement. Now, let's talk about life insurance and cash value life insurance. And I was recently having a conversation with someone that said, I just don't understand how life insurance could be a tax-free income vehicle. It's life insurance. It was created for death benefit. And it's there if I pass away in order for me to know that my heirs are going to be taken care of. How could it possibly work to create tax-free income? And so in order to understand that, we have to rewind the clock and take a look at history and the history of cash value life insurance. There are fewer policies sold today, fewer life insurance policies sold today than there were prior to 1988. That should be somewhat astounding. Why? Because our population has exploded. There's more people selling life insurance today than it ever has been before throughout any time in human history. But now there's less life insurance being sold today than there was prior to 1988. Well, there's a reason for that. The government stepped in and intervened in 1988. In 1988, the government issued something called TAMRA. TAMRA was the Technical and Miscellaneous Revenue Act of 1988. What this did is it changed the rules that govern life insurance policies and changed the way that they were taxed, specifically how the cash value in those policies was taxed. Now, if we go back to pre-1988, what you could do back in the day is you could take $1 million, plop it down into a life insurance policy on day one, and have $1 million death benefit. Now, if you did that, you were able to then take advantage of the rules that govern life insurance. And what are those advantages? See, life insurance falls under the same section of the tax code that Roth IRAs do. Your Roth IRAs, your Roth 401ks. You're able to put dollars into these policies, much like a Roth IRA. You put the money in, you pay taxes on it today, it grows tax-free into the future. Now, the way that you get funds out of a life insurance policy, a little different than a Roth IRA though. The rules that govern life insurance, now this was true prior to 1988 and today, allow you to do what's called FIFO. So they fall under FIFO rules rather than LIFO rules. This is one thing for us to remember. If we think about FIFO, let's say that we put $1 million into this policy, it grows to $2 million, and we want $200,000 out. Well, under FIFO, we wouldn't have to pay taxes on that $200,000 because it's first in and first out. So that is treated as return of our cost basis, return of our principal. Now, if it was LIFO, last in, first out, that million grew to $2 million, we took $200,000 out or withdrew it, now we'd have to pay taxes on that $200,000 because the interest was the last thing in. So that is LIFO versus FIFO. And we can also, with life insurance policies, we can take loans from that cash value, right? So we can take loans from the cash value. If it grew to $2 million, we could borrow out $1.5 million, put it in another investment and not pay taxes on the $1 million in growth while we're using it somewhere else. So those are the basic rules. And if we go back pre-1989, if you could put $1 million into a policy and have $1 million death benefit, there were real advantages to this because the death benefit was what? Was it $1 million? Not really, because $1 million of that was your money. So how much death benefit does the insurance company have to pay if you pass away? Well, they just take your $1 million and give it back to you, right? So you really didn't have a net death benefit. Now, I run into this question a lot with folks that'll come in and visit with me that are maybe closer and well into retirement. They have no need for the life insurance, maybe no need for the cash value for that matter, and they now have a policy that's built up $200,000 in cash value, and it has a death benefit of $300,000. And I say, what is the death benefit? And they'll say, $300,000. I say, is it though? Because $200,000 of that money is yours. So how much does the insurance company have to actually pay? they only have to pay $100,000. So your death benefit is actually $100,000. Sometimes it may not make sense. If you're not going to use the cash value and you're just going to leave behind the death benefit, it may make a lot of sense to start pulling that cash value back out to maximize the net death benefit that's actually going to pass on to your heirs. And so after 1988, what they did was they said, oh, we're on to you. We're going to change the rules, because with Roth IRAs and Roth 401ks, they limit how much we can put in, right? They don't allow us to put in as much as we want to each and every year. There's limits on our Roth IRAs, our Roth 401ks, our 403bs. But prior to 1988, you could take as much as you wanted and put it into that life insurance policy and have what some might consider a super Roth. Now, after 1988, they said, we're going to change the rules that govern the minimum death benefit. Essentially, they put into place minimum death benefit rules for life insurance policies. And they called this a guideline premium test. That is the 7-pay guideline premium test. This told us how much we need to have in minimum death benefit relative to the amount of premiums that are being paid into that policy. And if we put too much premium into that policy, they say, oh, that's now an investment. That is no longer a life insurance policy. That's going to be governed under different tax rules. Those new tax rules were MEC rules. So they created what was known as a MEC, a Modified Endowment Contract. So today, if you were to overfund a life insurance policy, put $1 million in and have $1 million death benefit and no cost of insurance, what would they say? Well, then they would say, you have a MEC. And if you have a MEC, the rules change. You're no longer considered as owning a life insurance policy for tax rules. Now, if you take a withdrawal, it's no longer LIFO. These rules basically turn your life insurance policy into an annuity. And annuities are taxed the same effective way. And they are taxed as LIFO rules, for one. So that is last in, first out. You put $1 million in, it grows to $2 million, you take $200,000 out, you're going to have to pay taxes on that $200,000. You're going to have to continue to pay taxes until you get down to your cost basis. You also see the elimination of loan provisions. You can no longer take loans from that policy. So you're not going to be able to take loans. You're not going to be able to also benefit from those FIFO rules because it's now LIFO. You also can't do what's known as a 1035 exchange without paying taxes. So you may or may not know that you can take a cash value life insurance policy that has gains in it and do much similar to what people do in real estate in a 1031 exchange. You can take that one policy's cash value and transfer it over to a new policy, and you've went like to like, so you didn't have to pay any taxes. You can no longer do that if you turn it into a MEC. And you also have to concern yourselves with the 10% pre-59.5 tax penalty. So when you do take gains out of a MEC, an overfunded life insurance policy that falls into those MEC rules, now you're paying a 10% penalty tax and ordinary income tax on your taxable withdrawals. So does this mean that cash value life insurance just doesn't work anymore? It does, but we have to exercise caution, and you have to know some things before you go down this road, because at the end of the day, what you're trying to do is minimize your cost of insurance and still benefit from that tax-free income growth potential that a life insurance policy can ultimately create for you and your family. So let's take a look at some numbers. Let's say that you wanted to go out and buy a $3 million term policy. You just need some insurance. You know you need $3 million in insurance. And you find that that 10-year term policy is going to cost you $1,200 a year. Now, then you go, well, you know what? I don't necessarily want to pay into something that I know if I live to year 11, the death benefit's gone and I've wasted all of the premiums that I've put into that policy. I want a permanent policy. Well, if you want a permanent policy, you're going to pay substantially more. You may be paying $24,000 a year instead of $1,200 a year. And you say, you know what? I'm okay with paying $24,000 a year because I'm always going to need this $3 million death benefit as long as I live, because I always maybe want to leave something to my heirs. Or I just know that I always want to make sure I'm getting my money out of this policy. And that is substantially more expensive. And you also know you're not building up any cash value because that $24,000 is purely going to fund that death benefit. But what you could do is say, I need the $3 million in death benefit. I'll pay $24,000 a year for that death benefit. But then how much more can I put into that that's not going to go directly to that cost of insurance? Maybe I want to put an extra $24,000, $34,000, $40,000 a year into that policy so that I can benefit from those tax benefits that a cash value life insurance policy gets. But the key is, how low can you get that death benefit and how much money can you put into that policy? And this is why it's important to work with an independent advisor that can shop around to different insurance carriers and show you what the minimum death benefit is that you can have in order to still benefit from this section of the tax code. If you would like to have those numbers ran for yourself, then all you have to do is contact our team and we will run you a variety of different numbers from different insurance carriers and show you what the minimum death benefit is, what that cash value growth could possibly be for you so that you can keep more money in your pocket and your family's pocket once you're gone. So just call the number on your screen to schedule a visit with one of our personal financial advisors, no matter where you find yourself in the country.